Hello, everyone, and welcome to NP Unfiltered, which is a podcast series where NP Capital Advisors will share actionable and practical strategies that help your business thrive. Some quick housekeeping. We'll try to take some audience Q&A at the end, so as we progress, please put your questions in the chat box as we go, and we'll get to them if we have time. Now, to quickly introduce NP Capital Advisors, NP Capital is a next-generation investment bank and consulting firm that offers tailored solutions across M&A, restructuring and turnarounds, and strategy and growth consulting. Our podcast moderator today is Justin Oltz-Green, who has over 20 years of experience building, scaling, and transforming businesses across the automotive, consumer products, and manufacturing sectors. He has successfully led growth from early-stage ventures to global enterprises exceeding 400 million in revenue, and most recently served as the executive director of ventures for Beach House Group, a 400 million ARR brand incubator and consumer goods manufacturer. So without further ado, I'll turn it over to Justin.
Thanks, Hannah. Welcome, everyone. And special thanks to all the panelists that have joined us today. So before we jump in, Hannah already introduced me, but just briefly, I'm Justin Oltz-Green, an operating partner at NP Capital Advisors. And as Hannah mentioned, I've spent the last 2 decades building brands, and now I spend most of my time with founder-led brands on growth, operations, and preparing for capital or strategic transactions. So I see a lot of what works and a lot of what breaks as companies scale. So I'd love for each of the panelists to give a quick intro, who you are, what you're building, and where you are in your journey today. So let's kick it off with Marc.
Thank you. All right, so my name is Marc Fetscherin. I own Bones and Friends. It's a small family toy business based in Florida. Before that, I worked a couple of years for McKinsey, run a luxury Swiss brand as a CEO, and built a career about branding marketing last 25 years. My flagship product is this little guy here. So it is a book and toy set for Halloween, similar to Elf on the Shelf. I'm excited to be here. Thank you.
Great. Thanks, Marc. Chris.
Thank you. My name is Chris Zaccaria. I'm an artist and I am the founder of the award-winning character brand Schnerds. Schnerds is based in Brooklyn, New York, and we use plush toys, storybooks, lesson plans, and emotional wellness tools to model self-love, acceptance, and curiosity for kids big and small. If you want to learn more, you can visit us 24 hours a day, 7 days a week at schnerds.com.
Awesome. Thanks, Chris. Jason.
Yeah, my name's Jason Klug. I'm a founder and CEO of a company called Klugonyx. We're a full service product development, manufacturing, sourcing company. We work with about 90 brands that vary industries from toy, game, baby, home good, houseware, outdoor products. And then I also run a brand that does home goods called Desai Home, where we make rapid drying bath mats, dish racks, dish pads, and other various items around the house. I've been doing it for about 13 years now, and yeah, the toy industry is one of my favorite spaces to play, and that's why we like to focus on that from a service provider standpoint.
Awesome. Thanks, Jason. Andrew.
Thank you, Justin and NP, for having me. I'm Andrew Klepper, sales manager at Packaging Corporation of America. I've been in the corrugated industry for over a decade. At PCA, we have over 120 facilities across the US. My focus is on high graphics packaging for national accounts. So your displays, retail and e-commerce packaging, along with fulfillment, including packouts and kitting. I spent a lot of time working with brands as they scale, helping think through how packaging decisions will show up across production, logistics, the customer experience, and how these decisions hold up as volume grows.
Awesome. Thanks, Andrew. And Nick.
Hi, I'm Nick Desai, founder and CEO of NP Capital Advisors. We are a middle market focused investment banking and consulting firm focused on consumer. And I've done a lot of work in food and beverage, beauty and wellness, automotive and toys. I'm really excited to have this amazing group of panelists today here to talk about some important issues that we think could be very helpful to smaller businesses, especially in the toy sector.
Awesome. Thanks, Nick. All right, let's get right into it. We've got a little less than 25 minutes in the podcast, so I want to jump right into the toy industry and where things stand today. The toy industry has always rewarded creativity. That's the heartbeat of the industry. But even today, at the early stage, building product just doesn't seem to be enough. What we consistently see in companies that scale are the ones that pair product and brand with real financial discipline and operational discipline. And they do that early, especially around cash, inventory, and the decisions that impact them. Um, a lot of founders don't realize how early that really starts, and where that starts to matter. So I want to start there. Um, so are you all the panelists? This is an open question, but I'll start with Jason. Are you feeling that already in your businesses, and specifically Jason, for what you've seen over time? Does this moment feel different in terms of how much discipline is required early?
I mean, yes, I think a big part of it, especially in the toy industry, last year with the tariff changes and, toy companies before barely having any tariffs to pay, that challenged a lot of companies to really pay attention to their bottom line and their cost of goods and their margins, and whether it's shifting and raising pricing. And if they're very retail driven, it's very hard for them to negotiate with their retailers that they've been in for a bit to raise their pricing, which adds a lot of challenges, right? And it's easy when you're a direct to consumer brand because you could raise your price on your website, Amazon, anytime. But when you're dealing with retail partners, it's much harder to do so. And leading into last year, a lot of companies in the toy industry, I felt like we're starting to focus on how do they become omni-channel brands where they're maybe heavily rep-driven distribution and mom and pop retailers, big box retailers, and they're trying to offset that risk by getting into more, online sales. And then last year happened and it completely, I mean, it shook a lot of things up. So the companies that I think got through it the best are the ones that already had a good starting point with their margin, and were able to absorb a little bit of that, but also were strategic on their cash flow and their pre-planning before the tariffs hit or waiting till they calmed down and were working around that. So yeah, it was definitely hard for brands to navigate
Yeah,
what's been going
yeah,
on.
super helpful. And I know, the toy industry being as seasonal as it is, it's planning for that inventory, especially when you have the impact of tariffs and lead times can be really, really challenging. Mark, are you feeling that already? I know, your brand right now is heavy D2C, but you're expanding into retail. Is that coming up for you?
Yeah, absolutely. I mean, it's after day one, you just have first expenses to deal with. And as Jason said, there are external factors, tariffs, but even not the tariffs alone. Now, the situation in Iran, are increasing shipping costs. So I mean, there are global events we cannot control, and we try to anticipate or build in our business model. Obviously, the higher margins are, and that's the internal aspect. The higher your margins are, the more flexibility you have to compensate to a certain degree those external costs, which sometimes, as we just said before, you cannot pass on to the retailer. You might pass on it to the consumer, but it's a difficult balance to deal with. In my case, I mean, it's a seasonal product, so I'm just with Halloween, so it's on somehow good and bad. I can predict it better, but if I have one production run, so if tariffs hit in that cycle of shipping, I have not much to do except maybe inventory, which is definitely another topic we'll talk about.
Yeah. Great. Well, yeah, let's stay on that and make that practical. Chris, how are you thinking about inventory right now? Are you playing it conservative? Are you leaning in? What's your strategy looking like?
At the moment, we are trying to lean in. For us, now is the time that we have to start planning for the holidays and planning for early 2027. So for us, we're looking at how can we get our new suite of school supply products, for example, on the shelves early next year or ideally later this year. So my expectation is that by the end of the summer, we'll have almost all of our orders placed for inventory, probably for at least the next 6 to 12 months. Again, I want to make sure that we get things on the shelves before tariffs or before there's any more price instability. But we did shift the brand. We moved Schnerds more into the educational space in 2025 to try and hedge against that a little bit, because now we offer the services of things like the lesson plans and emotional wellness tools. And a lot of those products we can actually make here on shore. So in that sense, it has caused us to kind of reevaluate the inventory that we need as well as where it comes from.
Super helpful. Marc, have you had a moment when you got inventory wrong, and what did you take away from it?
Well, the question is who gets inventory right?
Yeah.
Because, either you have overstock or you have stock outs. The way I deal with this is, the question is what's the cost of having stock, so inventory, versus stock outs or loss of sales. In my case, I'd rather have overstock because it is a seasonal product. So if I run out of stock in September or early October, I totally miss my season. And so that's I rather, try to deal with this. There are some other advantages. One is economy of scale. So if you do one production run, which we currently do, you get better terms in terms of cost due to economy of scale. It's easier for shipping. And also, there's another aspect, even it's a seasonal product. We actually see a spike across Christmas and now even in spring. So people buy bones also for holidays, for other holidays or gifts and birthday gifts. So it's always good to have stock than stock outs.
Yeah. Yeah. You've kind of diversified your product to be more than just the main selling season, which has been helpful, I imagine.
Right.
Andrew, from your perspective, how much comes down to planning versus just reacting?
Yeah, so with packaging, it leads heavily towards planning. The decisions involve more lead time and coordination than most people expect, especially across production, logistics, suppliers. So as companies grow, margin for these last minute changes shrinks. What might be manageable really early is much harder to adjust without creating mass disruption later on. So the reacting really late tends to create a downstream challenge, and planning becomes critical. So I think about the 5 Ps. Proper preparation prevents poor performance.
Hmm. Super
I
helpful.
like that.
I like that.
Yeah. So Nick, let's kick it over to you. What do you see better operators do differently, even at smaller scale?
I think one of the things we talk about a lot, Justin, as you know, is a recurring theme, is cash flow discipline. I think that's key for operators to be focused on. It is, I look at cash as kind of the oxygen that flows through a business. And it's really what gets you in the end. People look at the P&L, they look at profit and losses and gross margins, and they look at balance sheets and look at how much debt you have and how much AR you have and AP inventory, all this stuff, and equity, who owns what. The cash flow statement, I call it like the redheaded stepchild of the financial statements. It's just like I'm shocked at how few businesses are creating it, watching it, monitoring it, and really focusing on it. And it's those daily inflows and outflows that ultimately get to you, right? It's not owing someone money 3 years from now doesn't cause you grief today. What causes you grief today is a payment that's due this morning, and there's not enough money in the account to make that payment, right? And those challenges occur because of timing issues, and that's what a lot of people, don't pay enough attention to. And candidly, paying proper attention to that and making adjustments can extend your life in many instances quite a bit more than you may have imagined. And in business, extending life is the equivalent of optionality, which means waiting for something good to happen, right? And ultimately, that's what I've my many years of doing business, like that's what it boils down to is businesses, just like people, don't grow linearly. they kind of, chug along, chug along, chug along, and they have this big spurt. And you got to be there for the spurt.
Yeah, super helpful. Yeah, so building on that, what we see is a lot of companies tracking performance through the P&L, as Nick mentioned, but not necessarily managing the business through cash. Marc, how are you managing financials today? Is it mostly P&L or are you actively managing cash?
So I mean, I think I do both. For me, P&L is like theory. That's nice on paper, but cash on hands is, what is practice. What Nick said is, like when I have to pay my manufacturer to go into manufacturing, I have to write, I have to wire that amount of money or that they're gonna ship. While, I'm sure there's room for improvement in my case, but I think I do look at payment terms. So, for example, I requires my distributors to pay a certain percentage, close to 40 or 50% upfront, to help me reduce my financial stress. So when the purchase order is done, and then 10 days after delivery, this allows me to reduce my payment terms with my manufacturer to not have, a financial hole, in my case. Now, this is the second year, so these numbers are rather small. But when they grow into then, seven figures, it's gonna be difficult to still manage. And I think that's where companies like you guys might come in and do, short-term financing of certain things to exactly help elevate and alleviate that financial demand.
Yeah. Jason, where do you see early stage brands falling short financially?
Um, I mean, I think it does come down to, I mean, the biggest thing for consumer goods does come down to inventory and planning that, but also really paying attention to fixed expenses and figuring out when you hire someone. Also, like a lot of people waste money on expensive resources when maybe they don't necessarily need it at that time, or they're too small and they hire fractional CFOs and stuff like that. When we're in the day and age where we have resources like Claude AI, for example, and you can have a lot of deep conversations and give it a ton of context about your books, your financials, and your trajectory of your business, your upcoming sales and plans and retailers you're talking to, and then have pretty strong conversations about stuff with a with an intelligent tool like that. Like I feel like, and that's only what, $20 a month. So I feel like if you look at all of those things and pay attention to the resources you're using, be tight with budget, and then also don't say yes to everything. I feel like there's also, I've watched companies that have done very well. They're doing, high seven figures in revenue, and then they take a deal like a retailer like Costco, and Costco just crushes them because they weren't quite ready, or they were, it takes too much of a percentage of their revenue and cash flow to sustain a channel like that. They get excited about a big box when maybe they're not ready from a cash flow standpoint. And then also, as soon as you can, get a good banking partner, get a good line of credit. I feel like those things come valuable where you could leverage that debt as you need, and pull it in and out, and monitor your interest accordingly, and buy yourself some your own terms as needed. So
Yeah.
yeah.
Super helpful. Yeah. So Nick, Jason talked a little bit about the fractional CFO piece, and I think it's probably a good time to talk a little bit about cash flow management. I know we talk about the 13-week cash flow model. Can you give a little bit of context there about the forward-looking view and how we think about managing the cash cycle?
Yeah, a 13-week cash flow is kind of like a standard, tool that's often used. I think it's a period that's chosen because it's not too close or too far, so to speak, right? The one thing about cash flow planning and cash flow statements is because they are timing oriented. The farther out you go in time, the more inaccurate they tend to be, and the harder it is to guesstimate. So, looking at cash flow movements a year out from now is you could definitely make predictions, but they're going to have to be constantly adjusted. Usually what we like to do is rely on a 13-week and then also do a 52 week just so you have a little bit of an early warning radar, a little bit out, farther out, and having that thing updated, usually every maybe a week or every at the least every 2 weeks. Constantly updating, monitoring. The key to a cash flow statement is it's a very, it's a living, breathing, and changing document for a variety of reasons, and therefore needs to be constantly monitored and updated. But best practices, I think, are to look out, 13 weeks, look out maybe 52 weeks, and make sure you're updating it, weekly or every other week. Another practice that I've just found personally is a kind of a beneficial thing tool as call it a small business owner also, right? Um, is I like to have a cash flow call with my team, with my finance team I used to do it weekly, but I think again at least every other week, where I get a really good sense of all the checks, all the payments that are going out and all that are coming in. It's a good way to keep your handle on AR and AP. Call it. And by the way, cash, it's important to understand what's coming in and what's going out, obviously, right? What's coming in kind of tells you quickly, like who your bigger customers are, who's paying on time, where the money is coming in from. It gives you a really good sense of like the revenue side of the business, just on a practical, like from a practical standpoint. And then when you understand where the payments are going out, again, it just kind of gives you a good sense of like where the payments are going out, where the money is being used, who's being paid what. Sometimes during in those exercises you come across stuff that like, okay, well that can be we don't need that anymore, that can be canceled, that can be stuff like that. So just it's a good tool for me at least to really kind of just always have a really good sense of, because again, money is what drives this business, right, at the end of the day. So it's one of the most important things for me to be able to keep track on. And I know for a lot of sometimes for operators or founders, they don't want to get involved with that. They're like, oh, I'll just let my CFO deal with that. Or like, it's not a good practice in my view, unless you get to the level of like, tens of or even hundreds of million-dollar business where you really, really have a sophisticated CFOs and different level of management. I'm a big believer in like staying very close to money in and money out.
Yeah. Super helpful. So we've talked a lot about what it takes to survive and thrive. I want to shift to something that may feel early to some founders, but in reality, it shows up much sooner than most founders expect, and that's preparing for a transaction. Whether that's raising debt or bringing in a partner or eventually exiting. Marc, do you think about that at all today, or does it still feel too early for you? Where are you at?
Yeah, so I mean, of those options, I think the debt versus equity is probably the most urgent one. How I'm gonna finance and cross finance going forward. I think I'm not thinking yet about exiting. Also, I do have some talks about licensing, but that's really more growth, sales related than really exiting the business. So in that sense, that these are my key questions. But I want to come back with the point Jason said, which is crucial, I think, about AI and fixed cost. I think, I try to have my fixed cost extremely low. I try to outsource and make it as variable as possible. That helps me with the low cash burn rate. And I'm almost a tech company. I use like 5, 10 AI tools. I integrate them, which again helps me to automate and to reduce cost. And only once, I'm profitable, that's when it makes sense to even talk about transactions and going. So you need to first fix your business model. And because you can only scale businesses if they're healthy businesses.
Yeah.
Yeah, what Mark brings up is so important from a standpoint of like lowering break even point, right? Because his approach of keeping fixed costs low substantially lowers the break even point, which is really I think something I would also like look at in business as something that again learn the hard way and the painful way. It's very easy to let fixed costs and overhead get bloated very quickly, just with little things adding up here and there. And it's like this subscription here and this other thing there and this membership to the thing. And before you know it, it's like there's thousands of dollars a month just leaking out, and it's shocking how quickly all of that adds up.
Yeah. Chris, how are you looking at the business in terms of what's next from either a capital raise or an exit?
Well, like I say, make me an offer and we'll see. Uh, so for a capital raise, right now we're in conversations with a couple of big retailers and a few significant licensing deals. And so at the moment, we're waiting to see where those go. Um, that would give us obviously a lot more leverage, and especially because we really can offer equity. Leverage is something that is very good. The one thing I do want to say is if we go back to keeping costs down, speaking of equity, I've had a lot of success in partnering with equity-based advisors. So you give a small equity grant to a person, and then they work effectively with the understanding that they get paid out in the future. And that's been a really good way for me to keep my costs down, as well as to get a level of expertise that otherwise I, at this moment, could never afford. So I do want to put that out there um, as something for people, especially people with a small business, to consider.
Yeah. Jason, you're going through a transaction right now and you're looking at some others. Without getting into anything too sensitive, what's been the most real or surprising thing about that process?
Uh, I mean, the macro side of it, uh, multiples of EBITDA fluctuate quite a bit. It's crazy to hear about some of the deals that went down in like 2021 where people were getting 12, 13x multiples on their EBITDA versus now I feel like if you're within 6 to 8x in a consumer product business, you're in a pretty decent spot from a acquisition standpoint. It's also interesting where a lot of companies focus on top line, top line, top line, where even my company, through the tariffs and, consumer behavior and selling a premium product, last year, the beginning of the year when the tariffs hit, we made a lot of fixed cost adjustments on some of those fixed expenses and open up bottom line, but we were just above flat in revenue. But our bottom line compared to the year before, even with tariffs, went up 30%, so telling that story in conversations around acquisition, it was more of a focus on EBITDA growth versus top line growth. And a lot of companies I've seen in the past that, they focus on top line, top line, top line, and they lose track of that bottom line, and they do fire sales, because they've grown so quickly. They're having to acquire more inventory, more resources, they're hiring, and then before you know it, they're that bottom line shrinks 1% every quarter, and they're in a much worse spot than they were when they were doing less revenue with steady growth. So yeah, it's interesting because when you go into it, you think, oh, they're going to look at top line and what our revenue did this year compared to that year. But it's surprising how much of the discussion has been around the health of the EBITDA and what we've done as a company to improve that.
Mm.
So
But to Jason's point, there's two ways, like in business, right? Ultimately, there's two ways to get money, right? And ultimately, business is about, like, at least for-profit business are about making money, right? One is through the cash flow generation of the business, and the other is through the sale of the business, right? Which are two kind of slightly different things. You can almost analogize it to the stock market. Like what Pepsi stocks trades for is not necessarily always directly related to its cash flow, although in theory it's supposed to. In practice, I mean, it fluctuates so much, and often it's so divorced from the fundamentals, especially these days. But the reason I bring that up is because there's two ways to play that game, and if you're going to play it the way the revenue game, it's like Jason was saying, it's like a game of hot potato. You better find someone to buy that thing off your hands, right? That's the only way it works. And that has worked, like for many businesses, but usually it comes in the form of they get a ton of capital, they keep getting more capital, keep getting more capital, drive that revenue, and then ditch it to someone else, and someone else pays for it. That's the only way out. And if that's not going to work, then then that's when often when those things go to zero, because unfortunately the cash flow of the business usually it hasn't amounted to much, or is even negative. And I'm always shocked at like companies when like I remember like in food and beverage. I remember the one example, like Beyond Meat was one that just comes to mind. It was like I would always read about, like, oh, the revenue, doubled from last year 100 million to 200 million. And I'm like, wait, at first of all, at 100 million dollars, if you still can't make money, I'm like scratching my head. But then this guy goes to 200 million and the losses got greater, got bigger. And I'm like, something's off here. Like this thing's losing money at a gross margin level, right?
Mm.
if you're losing money at a gross margin level, you got to really figure out whether you even have a business.
Yeah. Yep. I know we're right at time. I wanted to wrap up just with some quick fire answers from everybody, just a quick round the table, and then hand it to Hannah if we have any Q&A. So real quick going around, what's one thing founders should focus on in the next 12 months? So we'll start with Chris.
I would say broadening the perspective of what it means to have a toy company and looking beyond just kids.
Hmm. Awesome. Jason?
I mean, if one thing in consumer product, I'd say do what you can to get a tariff refund if that actually happens. That's a nice little cash surprise that some of us might be able to get, which would be exciting. And then just constantly pivoting, but also to the cash flow statement side of things, don't be afraid to make cuts and or it's better to make cuts earlier than later. If you could do them a few months in advance, you're going to feel much better when you get to those those pressure points that you could you know get to with lower cash. So yeah, don't be afraid to pull the trigger on something that might be difficult to do.
Awesome. Marc?
Uh, I think technology. I think when you just think about ChatGPT 2 years ago, it feels a decade. And as Jason said, I mean, I heavily use technology in all the ways from creating content, writing, managing processes, everything. I think you can leverage technology, and that might give you a competitive advantage, especially when you're a small company. I can implement technology solutions way faster than big corporation can. I'm
Mm.
actually just signed up for an AI course at Harvard Business School online about that. So to do a certificate. So I think technology is, at least I see this as an opportunity to really stay competitive, reduce my cost, improve efficiency, and that's what the bottom line is.
Mm. Great. Andrew?
For packaging, I would say make thoughtful decisions early. The choices are much harder to change later. Packaging touches every part of your organization, and it's a highly engineered product designed for a specific purpose. Packaging can really influence how efficiently you operate at scale as well, with those early decisions.
Great. And Nick?
Yeah, I was hoping that I'd be able to say this answer before anyone else did, but I think Mark took it. But yeah, I would say AI, which basically is technology. It's how is AI gonna, change your business? If you look at 12 months out, I mean that the rate at which that's changing, that world is evolving is just unreal. And what's gonna happen in the next, in our lifetimes, is gonna be like just fascinating to watch and be part of, I think. But like I think everyone who has a small business, and I think Mark nailed it, like the one it's like what's happening in the Strait of Hormuz. I've been reading about it, where you're like these small fast boats are like attacking these huge massive tankers. Why? Because their ability to move swiftly and maneuver quickly is actually a huge advantage. That's exactly the advantage that small businesses have, right? With technology adoption and so many other things. And so I think like right now I'd be thinking about how technology and AI can be used in selling whatever you're selling, in making whatever you're making, and in operating your business, all of those different arenas.
Yeah.
Yep.
Excellent. I appreciate everyone sharing. It was really, really insightful, well-rounded conversation. And I think, Nick, you kind of nailed my takeaway as I was listening in. You don't have to be big to build a valuable business. But the earlier that you have discipline, I'm sure a lot of those small boats are coordinated in their counterattacks. So just discipline for me around cash operations and decision making. It just creates more optionality, like you said, Nick, down the line. Um, well, thank you, everybody. That was great. I want to hand it back to Anna or Hannah, sorry. Do we have time for Q&A?
Um, we, I'll just have one. So Nick, can you quickly fill us in on how NP Capital can help consumer companies navigating this new market? Like, how can they work with you, to boost their top and bottom line?
Well, we are NP Capital has three different groups. One is the fractional, executive group, which was as fractional CFO, COO, CRO type services. The other is a mergers and acquisitions advisory group, which focuses on helping companies sell their business, buy a business, raise equity or debt capital for a business. And the third is a restructuring and distressed advisory group, which focuses on companies that kind of maybe didn't have that initial discipline or got carried away and ultimately didn't watch their money in the ideal manner and got short, or sometimes just things go against you in different ways. But have giving them the ability to have what I call a second chance is a big thing that NP Capital is a big believer in it and has become very good at doing for these small businesses. So we're always eager to have conversations where we want to be supportive to the founder ecosystem. We are ourselves founders, everyone in our firm, starting from myself, and all the senior members of the team, Justin, Brent, others are all, have all run businesses. That's a big mantra and big, thing that's important to us in terms of the backgrounds of our key, the key members of our firm. And so we love to be what I call, we love to help David win against Goliath. We think David actually has a lot of strengths, and a lot, like going back to this, the fast boat analogy. And sometimes Goliath can have a lot of weaknesses, and we like to find ways to help Goliath exploit, David help exploit Goliath's weaknesses, and in order to find ways to win in a system that often can appear, rigged at times, and where the odds are definitely stacked against you.